everyone. We are Mortgage Pros 411. I am Audrey Boycenow and with my co-host Kevin Casey. And today we are joined by the real live Dan Habib. How are you, Dan Habib, with
I'm
MBS
doing
Highway?
great. I'm doing awesome. It's great to be with you guys.
Oh my God, we always love having you here.
Our
It's
last show
so
of the
good.
year.
What'd you say,
All
Kevin?
right.
Our last show of the year.
I know, that's crazy. Okay, so I just wanted to say a few things. First of all, we know that it has not been easy this year. We know that 2023 has been, I'm going to go with difficult. However, we have so much to be grateful for. And the first thing we are grateful for is the people who listen every week for an hour, for God's sake. I'm always blown away by that. So we just want to say thank you to all of our listeners and thank you for sharing us with your friends and your colleagues. And yeah. Second, we want to thank Jason Bellevue. He does our YouTube channel. If you didn't know we have a YouTube channel, because he always yells at me that I don't mention it enough, thank you to Jason. He does this out of the goodness of his heart because he thinks it matters. And we are so grateful because without that, you wouldn't have anywhere to go if you missed the show, right? And you can put us on double speed just in case we don't talk fast enough. You can make it even faster. And yeah, we'll probably sound like the chipmunks, but whatever. Anyway, and then Gina Pasquini, who does our flyers and sends out a notification every week. She's really great. And I don't know what we would have done without her over the last however long it's been. So thank you, thank you. And then finally, our speakers like Dan, who shows up with a smile, puts up with my questions and my lists, and is gracious and lovely and generous with his time and information. So Dan, thank you to you, and thank you to everyone who comes and helps us do this every week. It's really something else, isn't it, Kevin?
It is quite something else. Hey, you know what? Thank you, Audrey.
Oh, well, thank you, Kevin. Oh, yeah, there's that. See, I never go there. I never think of that. Just remember, just check out our YouTube channel. You can subscribe, Mortgage Pros 411. Share us with your friends, your colleagues, account executive, realtors. They're all finding value in this. And yeah, there you go.
Yeah,
So
please share it.
grateful, grateful, grateful. Just a reminder, if you haven't renewed your NMLS at this point, you're probably screwed, just
Too
to let you
late.
know.
Well, it depends what state you're in. So some
Okay.
states, there's no waiting period.
Oh,
But for a state like California, even if you hit the deadline of the 15th of December, even if you got it done before then, it might not be renewed. So you might be taking an unexpected vacation on January 1st.
well, we're all taking a vacation on January 1st. So doom and gloom
Well,
aside.
yeah, but you might be taking a prolonged vacation, not just.
All right. If you are, if I'd be curious if anyone is willing to admit they haven't done their 8 hours yet. If you have not, mortgage educators, you use the discount code countdown and knock that out. Get it done like wait till you get done with this today and then get online and get it
And
done.
just for the record, they're slammed with people trying to do last.
I know. Isn't that crazy? They are slammed. All right. So Dan, it's all you, baby. So we are so happy that you're here on this particular day because there's so much to talk about. Let's start with the Fed, shall we? So
Yeah, that's really the big news that we saw over the last week, right? So
Yeah, that's nice news.
the Fed
Yeah.
made a big pivot, in my opinion. And, not only are they now not talking about hiking rates anymore, you could tell the conversation has been, when are they going to start cutting and by how much? And, this is now the third meeting in a row that they paused. I've been saying that I thought the Fed was done for several meetings now. But if you take a look at some of the questions posed to Powell and some of his comments, I think they were quite telling. So this was really, I think, one of the first times that they outright, acknowledged how much meaningful progress they've made on inflation, almost taking a bit of like a victory lap. But, there's somebody by the name of Nick Timiraos from the Wall Street Journal, and he really teed Powell up to kind of push back on what the market estimates have been. And what I mean by that is that the markets have been pricing in rate cuts in 2024, and every public appearance that Powell has had, he's really used that as an opportunity to kind of walk those back. But he did not in this case. Nick Timiraos basically said straight out to me, he said, listen, the market's projecting, 6 cuts in 2024. How do you feel about that? And he didn't push back at all. And in fact, if you take a look at what's called their dots plot chart, that's where the 19 Fed members anonymously plot where they think the Fed funds rate is going to be. Now, of course, you had a couple hawks that had 0 cuts priced in, but the vast majority are pricing in 75 basis points worth of cuts. there was also 4 members pricing in 100 basis points of cuts and 1 member pricing in 150 basis points worth of cuts. So that is a big change from the Fed. And this was obviously well received by the markets. Now, rate cuts are going to be important. And if you look at where the market believes the Fed's going to start cutting in March, actually. Let me share some real-time numbers here for you for the market, right?
Right.
So market's pricing in an 84% chance. And this is something called the Fed futures. So this is where the market is essentially the betting line on when the Fed's going to cut.
Right.
84% chance in March. And then they're pricing in 100% chance at the May 1st meeting. Or I should say by there. But then there's an 80% chance that they'll have cut by 50 basis points by this meeting. And then 100% chance by June 12th, and 81% chance of 75 basis points worth of cuts. So if they were 25 basis point cuts, the market's thinking by June, by the end of that meeting, they'll have done 325 basis point cuts.
Wow.
Now, of course, these numbers can change. It's not, they're not always correct. These numbers change, very rapidly, but it just shows you where the market is expecting the Fed to be. And while Powell was very dovish, I thought it was interesting because we've since heard from some other Fed members,
Yeah.
John Williams, the New York Fed president, Austin Goolsbee, Loretta Mester. They almost played the part that much of the market was expecting Powell to play, right? And while Powell didn't push back at all, these Fed members have come out and sounded a lot more hawkish, although the market doesn't really buy it. You had all these 3 Fed members, some of which are voting, saying that we shouldn't expect that many cuts. The market's going to believe what they want to believe. We're not necessarily. John Williams came out and said, we're not even really discussing cuts, but really how long we're going to keep the Fed funds rate where it is right now. So really tried to walk back some of that optimism and that dovishness, but the market simply isn't buying it. But here's the thing that I want everybody to think about, which I think is going to be more important than the cuts. So the Fed has been doing something called quantitative tightening. Right. So here's what that means. This is a picture here of the Fed's balance sheet. So if we go back here to 2020, right, the Fed was doing a ton of buying of mortgage-backed securities and treasuries, and it was called quantitative easing. So that's where every month they were buying like 95 billion in mortgage bonds and treasuries. And this was artificially keeping rates low, even though inflation began to rise. And the Fed did this to stimulate the economy after COVID, keep rates low, promote expansion in the economy, and it certainly did work. But they amassed a massive, massive balance sheet of, somewhere under $9 trillion. Now, the Fed, even when they stopped their outright purchases, meaning even when they stopped just buying mortgage-backed securities and treasuries, they did something called keeping their balance sheet net neutral, which means that when the Fed received, principal payments and payoffs and things like that, or when the treasuries they had on their balance sheet matured, normally those things would fall off their balance sheet and their balance sheet would come down over time because they're not outright buying anymore. But what they were doing was reinvesting those proceeds. So anything that fell off, they would buy more mortgage bonds and treasuries to keep their balance sheet at the same level, meaning it wasn't going down. Wasn't going up either because they weren't outright buying, but anything that fell off or matured, they were reinvesting. So that means that even when they stopped quantitative easing, they were still being very stimulative to the bond market and interest rates. But since 2022, notice how the balance sheet's been going down. This is QT. And I'm not trying to be cute here. It's quantitative tightening, right? So that is really the opposite of quantitative easing. And what that means is they are now allowing those assets to fall off their balance sheet. So this has been the big problem with mortgage rates because you see, you had inflation at 9%. It's come down to 3.1% on the CPI headline. Core's come down to 4%. The PCE numbers are even a little bit lower. But we haven't seen mortgage rates, although recently they've been coming down a bit. We haven't seen them come down as much as you would expect, having so much progress on inflation. And the real big reason is the massive supply of treasuries that has to be absorbed by the bond market. And at the same time that you have this massive supply of treasuries come into the market because of the increase in the debt ceiling of $2 trillion since the summer, because you have foreign nations not buying as much, because you had banks that some of them went under, the second, third, fourth largest, and the FDIC has been selling all their assets, or other banks having to sell mortgage bonds and treasuries that they had on their books to come up with depositor money that's been fleeing. All of these things, meaning a lot of supply that has to be absorbed by the bond market. At the same time, you have the Fed, who's reducing their balance sheet by $1.2 trillion over the last year. So when you have all this supply of treasuries, when we go into debt, the Treasury issues treasuries, right? And then that has to be absorbed by the bond market, and there's going to be demand at some level, but where's that equilibrium price? Well, when you have a flood of supply coming to market, the price has to come down, and with bonds, right, or treasuries, the yield inversely correlated goes up. So that, in my opinion, is the main reason why we haven't seen rates come down as much. So the Fed has been doing quantitative tightening, and that's another like 1.2 trillion over the last year that had to be absorbed by the market. So the reason I bring this up is because the Fed is likely, in my opinion, not going to want to have one foot on the gas and one foot on the brake at the same time as they're driving this car down the road. So I think after they begin cutting rates, with which I estimate to be, somewhere around that May meeting, I think is a good thought. I think maybe not at the May meeting, but shortly after that, maybe the following meeting in June, I think they're going to begin reducing their quantitative tightening, or a word they like to use is called tapering of their quantitative tightening, which means they won't allow as much to roll off their balance sheet, and they will take a portion of it and reinvest it into mortgage bonds and treasuries, which means they're going to once again be somewhat stimulative to the market, and they're going to absorb a pretty good amount of the supply that's coming to market. And that has a trickle down effect on other banks because of other banks' reserve requirements. That could, I think you could see, I'll actually have a slide to show you some of the numbers here on this, but let's just pull this up real fast. So here's a kind of basic summary of what we're seeing, right? So you had the deficit increase by $2 trillion. You just have normal MBS issuance from deals that all of you were doing of about 1.1 trillion. Balance sheet runoff is somewhere between 1.1 and 1.2 trillion. So you got 4.2 trillion of supply that has to be absorbed by the bond market. But if the Fed starts tapering their quantitative tightening, meaning instead of letting 1.1 trillion roll off, maybe, they reduce it by 400 billion. Well, now that's 400 billion that they're going to be absorbing. And then the banks, because of that trickle down effect of their reserve requirements, instead of letting 800 billion of selling 800 billion or reducing their balance sheets by 800 billion, maybe we get a benefit there of 500 billion. So the bottom line is that the total amount of supply is almost cut by a quarter if the Fed were to start tapering their quantitative tightening. And I think eventually they're going to remove it, but this would have a big impact imagine if the quarter of the supply out there in the treasury market was now going to be absorbed, and it's a lot less that has to be absorbed by the overall market. So I think that's a big thing that people aren't thinking about.
Are you also considering the fact that if rates come down, we're going to be generating more business, and that's in that
Yes,
already?
volume.
Yeah, I think that, that we are considering that, but I think that this is going to have a much bigger impact than that. I think there's going to be other factors too, right? So you're going to have, I'm expecting a global slowdown in the global economy. Normally we have a lot of help from foreign buyers because our paper is really the best quality, and typically they take up about 50% of the market. Right now they're only buying up about 30%. But as their economy is slow, probably more so than ours, there's always a flight to the bond market and to safety during those times, but especially from these foreign nations, because ours will be of the best quality and such. So, a lot of smart people I talk to that are smarter than I, like Lacey Hunt, for instance, thinks that we're going to see a lot of foreign participation, as well as some of the things that we just saw. And I think there's a good chance, and so does he, that we are not out of the woods with a recession this year.
Right.
If you look historically, we usually don't get a recession until really like after the Fed starts cutting.
Right.
But everything that I'm seeing out there, and maybe the Fed changed their tone because they're seeing some things that maybe we're not. But everything I'm seeing out there is pointing to, at least comparatively, a much slower fourth quarter than the third quarter and slower first quarter of 2024. And there's other things like the unemployment rate that I think we have to watch closely. There's some signs out there that have like 100% accuracy, where if you see the unemployment rate, it's really about the rate of change. If you see it go 0.5% from the cycle low, you almost always get a recession within the next few months. And the cycle low of this cycle was in April of this year, where it was 3.4%. That unemployment rate shot up to 3.9%, 0.5% above that level. Now, in the last jobs report, it did come down a little bit more, back down to 3.7, but I still think that that indicator was kind of hit. And I expect the unemployment rate to continue to go up from here and job growth to slow. So I would keep a close eye on that jobs data. And on the inflation front, Audrey, one of the things you mentioned was annualizing the inflation, right? So I believe what you were referring to is something Powell talked about, which was
Right.
the 6-month run rate essentially of
Right.
inflation. It's something he's looking at. So if we look at some of the absolute numbers, right? So CPI is at 3.1%, and the core, which ships out food and energy and is the Fed's kind of favorite focus, they like to look at the core because food and energy prices can be impacted by things out of their control. And maybe you have OPEC cutting production levels or some type of bird flu or drought, whatever it may be. The Fed can hike all they want. They're not going to stop those increases or decreases happening there. So they like to look at what they feel they can control and they can measure if their monetary policy is working. So the core is really most important. And if you look at the core rate of inflation, it has been coming down, but it's really being held up by shelter costs, which are lagging behind because of the way they calculate the data. If you were to catch up and use like real shelter costs versus what they have in the CPI because of the way they calculate it, it wouldn't be 4%. It would really be like 2.2%. And it's not too dissimilar if you use the Fed's favorite measure of inflation, PCE. And by the way, this Friday, we're going to be getting some really important new readings on that, where I anticipate to see a little bit of improvement on both the headline and the core numbers. But in any case, I think job growth is going to slow. Unemployment is going to go higher. Inflation is going to continue to come down. And if you just look at the recent trend, if you look at the last 6 months of the core CPI, and then you annualize that, essentially, since it's 6 months, you just multiply it by 2, that shows you a more recent trend of where things are heading. On CPI and the core, instead of 4%, you would get 2.8%. On the core PCE, if you did that same exercise the last 6 months and then annualize it or multiply it by 2, you would get 2.4%. So remember, the Fed's target is 2%, but now we're getting pretty close. And I think once you get a 2 handle on inflation, that's going to be a big win for the markets and the Fed. And, one other thing Powell said, pretty outright was, listen, we're not going to wait for inflation to get to our target before cutting, right? That's almost like, if you're driving down the highway and you have an exit, you're not going to like start hitting the brakes when you're at the exit, right? You're going to miss it, right? You're going to blow past the exit, right? So you want to slow down in anticipation of it.
So I just want to go backwards just for a second. First of all, just a reminder, it is never a straight trajectory up or down. It is not going to be, woohoo, okay, rates are now going down, and it's never going to do anything other than that. So just remember that. And then going back to your schedule of the way of how the market has projected the rate cuts will happen next year.
Mhm.
Again, remember everyone that we could have a war, or we could have a debt ceiling crisis, or we could have bank failures, or we could have any
Government
number of things we haven't
shutdown.
even imagined that can come out of nowhere and knock all of that off of its, um, what's the word I'm looking for, Dan? I don't have anything appropriate in my head right now.
Black swan
Anyway,
event.
what?
A black swan event.
You can
Anyway,
have some unexpected occurrences.
there we go.
Yeah.
2023 was just so full of things, and actually we can just go back, and it's just the last few years have just been one thing after another you just didn't even see coming. So just remember that, we think that, okay, this is going to happen, and if you're taking very educated guesses, that is correct, but just don't make promises over things you can't control. This is what we are expecting based on X, Y, and Z. And just make sure you're explaining things properly to your realtors, to your clients, your referral partners, so they understand that this is what we see coming, but it could, have a slightly different timeline, or something completely different could happen, right?
Yeah. And, I saw that you had sent me some notes that somebody came on Diana Olick's show and
Oh my
was
God.
saying that rates were going to come down to like 4% or something like that, right? So I think that would be pretty optimistic, but I could
Yeah,
tell
that's-
you, my forecast is that in 2024, we'll probably see, low sixes and maybe even get a 5 handle on their high fives if we get lucky. It's going to
Yep.
depend a lot on, how the economy performs. And if we see, recession-like conditions, that as a silver lining will definitely help the economy slow, inflation come down, and rates to come down too. But even at low sixes, or if we get some high fives, I think that's a different market. I think
Yep.
we've seen the
Yep.
bottom in volume levels.
Yeah.
Taking a look at existing home sales, new home sales, and even numbers like we got from builder confidence and housing starts and permits numbers that we got this morning.
Yep.
I think the worst is behind us as far as volume levels go. And there's a lot of supply that's going to be coming to the market on the single family housing front. We've seen it switch because it was like all multifamily, but with the Fed raising rates so much, those homes are getting completed now, but that's part of the reason why rental prices are coming down. But we're now seeing like 3 times as many housing starts on the single family front. A lot of those multifamily projects just don't pencil with
Right.
where rates are right now and the cost.
But the builder
But
confidence is really rising. So I think the builders are saying where the projection of rates are going. And they're
well,
thinking,
it's still low. It's still
Yeah.
low, but in this report, it did turn higher, right? But
Yeah.
the
Right.
absolute level at 37 is still in contraction, right? So it's an index that goes from 0 to 100. You want to be above 50, which signals
50,
expansion.
yeah.
But it did turn higher on traffic, current, present situation. I mean, on the overall number. And then there's like 3 components, right? It's current situation, it's forward looking, what the future expectations are, and then it's buyer traffic. The current situation remains the same at a level of like 40, but the future expectations rose pretty largely by 6%. And you're correct, they did note, they're more optimistic about the future because of lower rates, but also now we got the winter kind of months getting behind us here, right, as we get into next year. And also, I think that if you look at buyer traffic, that increased a little, but that's still at pretty low levels, so like 24 or something like that. So it turned in the right direction, and I
Right.
think it
Right.
will get better from here, but still at low levels.
But when
I
we're
heard
looking
someone,
at household formations over 2 million a year, and then we're
It's like
still
just
looking
under that.
at new homes built at much lower than that. So we're not at all in jeopardy of having, too much supply in the market, especially based on the millennials and the Gen Zers who are buying houses like crazy or want to buy houses like crazy. So we're still like completely out of balance as far as supply and demand goes is housing, correct? And
Yeah,
for the foreseeable future.
so it's a great point to bring up, right? Because we are seeing more single family supply that's being started and will be completed. So it's a good question. If we have more of these homes coming to market, what does that mean for prices, right? I mean, does that mean that we're going to see home prices at risk of coming down because you're going to flood the market with supply and you're not going to have enough demand? I think it's a very valid question. But if you take a look at household formations, which is your demand component, right? That's people living at home with mom and dad and then moving out to go buy or rent a home. If you take a look at people getting separated, maybe they're married and they're one household, they get separated, now you have an additional household, right? So that's a household formation, and it's your demand component. And then your completions are builders completing homes and putting them on the market, right? So household formations currently are just under 2 million. So close enough.
Under.
It's like 1.97 or something like that, right? So call it
Okay.
2 million, but your completions are around 1.5 million. And you have to remember too, there's about 100,000 homes every year that has to basically be replaced because it ages too much and it's like got to be like, demolished. So you have like 2 million versus 1.4 million. So you still have
Okay.
much more in the way of demand than supply. I think if you were to ask me my projection for 2024, I think we're going to see somewhere in the neighborhood of 4.5% to 5% appreciation for the full year, which is still
Great.
really meaningful. I mean, I would,
Great.
yeah,
Yeah.
I mean, if you got 4% appreciation, right, and it's a $500,000 home, that's $20,000. And if you put 10% down, 50,000, well, 20,000 on 50,000 is 40% return on your investment thanks to leverage, right? You have to pay to live somewhere to buy or rent, right? So, I think that's an important concept to explain
Yes.
and get out to
Yeah, well, I
customers
mean,
because it's hard to figure out.
Fannie Freddie numbers, increased year over year at 5.5 for the conforming limits. So your numbers are right in there. fact, even kind of, oh, it's even slowing down a little bit.
I feel like when we were at 5% before COVID and all the crazy, we were thrilled. And it was, you don't want to be Ohio where you have no, for a long time you had no appreciation, but you also don't want to be California where you're at 30% or 20% or whatever crazy numbers they were all over the place. Like 4 or 5% to me just sounds Goldilocks, right? Just
Yeah,
right.
no, definitely a lot more sustainable
Yeah,
than some of the higher
exactly.
levels. So.
One of the things I'm hearing just in the news all the time, people, oh, prices are still high, even though inflation is going down. No, inflation is going down. That means it's slowing the rate of appreciation, not going down. And
Well, yeah,
that would
that's a
be
great,
deflation.
it's a great point. I hear this all the time, right? So people will hear, people in the media or even us talking about
Yeah.
how inflation has come down. But
Right.
what we're talking about, and then people are like, I don't know what you're talking about. I see the prices of things out there and they're still much, much higher.
No, they
Inflation
were.
hasn't come down.
Yeah.
It's not that
The prices come
inflation
down.
has come down and gone like negative and the prices actually move lower. When we talk about inflation, we're talking about the rate of change slowing, right? So in a Fed's ideal year, prices continue to go up by
Exactly.
2%. But that doesn't mean the previous gains that you saw aren't already baked into the cake there, right?
Yep.
So we had 9% inflation. Okay, that's in there. Then you have, a year where you have 3% inflation. That's 3% on top of that. But then the pace slows to 2% or whatever. That's the Fed's target. You're still gaining 2%. So we're talking about the rate of change slowing down.
Yeah.
And the Fed's goal is for that rate of change to be 2% on a year-over-year basis.
Correct.
Inflation always goes up, right? I mean,
You
I'm not
want it
old
to
enough
go
for
up.
this, but it used to be.
Because otherwise you get deflation, and deflation is a terrible thing because it's really just kills the market.
Well,
Yes,
so, okay, so
and
if we were to, do you know the number? So it's interesting. Our guest last week, Victoria DeLuce, she had mentioned this in that, don't forget that we had the inflation from 2021 and 22 and 23, and you add them all up, and yeah, we're all excited about, the rate. But to your point, we have to keep in mind it's the rate of increase, not that the inflation has shrunk that happened at 9% in 1 year all at once, which I'm trying to wrap my brain. I was telling Kevin, my yard guy decided that he was going to jack up my price over 20% starting in January. I'm trying to wrap my brain around that. And we play a little surcharge in my neighborhood anyway. They're like, "Oh, we'll just sock it to you." But I'm like, do I just tell him to go stick it, or do I, like, I'm just trying to figure out,
Yeah.
as far as the prices. And then I was having this conversation with my cousin the other night who owns a successful restaurant in the area, and he was talking me through how he's figuring out how to price things in the restaurant, and, like, can he afford to have a hostess seat somebody? How much does that cost? Like 50 cents to have them walk them from the hostess stand to the table. I'm like, okay, so, but then on the flip side, how do you quantify what are you missing out if you don't have a hostess? Like, what customer doesn't come in? So all of these numbers and all of the inflation we've had and the impact that it's had for all of us with our prices going through the roof on all sorts of things, including food and energy, which gets stripped out of core. So I'm just fascinated to see how this all lands, and does it correct itself at some point? Like, are we really going to pay $25 for a freaking hamburger forever, or is that going to moderate? You know what I mean? So I don't know. The inflation thing is fascinating but terrifying. And
here I will. I'll show you what inflation looks like over time, so you can see it. Right. So
thank you.
this is an index. So this is showing you overall prices, meaning it's
Right.
not showing you like what the gain is each, like what like the percent gain is. So you could see over time, we're going back to like 1940s here, right? Inflation pretty much just always goes up. You can have some temporary periods where you actually get deflation, right? Like you saw that a little bit here in 2008, right? But the vast majority of the time, this chart is up and to the right, right? So you are seeing, inflation really just go up, sometimes at different rates, but it's always going up. But remember, incomes are constantly always going up and other
Thank
things
you.
as
Yep.
well, right? So but yeah, I mean, you're not going to go back to a nickel to go see a movie anymore either, right? So
Well, I don't
yeah,
expect
those
that, but I
things.
wouldn't mind a $12 hamburger, for God's sake.
Well,
Okay.
you can see some price reduction in products. Because that's the only one that can change, because the wages aren't going to go away. No one's going to suddenly take less to work. The McDonald's workers are, they're pretty much set at whatever.
No, but what's
wages are
happening
going
there,
up.
Kevin, to my cousin's point is,
Oh yeah,
that
they'll eliminate workers.
they're going to automate it. They're automating it to get rid of the workers, which,
Right.
okay, like, so anyway, so Dan keeps referring to my list. So I am constantly on the hunt for things to talk about on Tuesdays, things that are interesting, information that might be valuable, little tips, whatever, right? I make notes constantly. So I have a little special list for Dan, because Dan is a little different than the rest of the crew, whereas I could just throw him a bunch of things and I don't have to carry it. He can carry it. So it is so
Yeah,
going back.
another one
What?
you had on here was Jamie Dimon's comments
Yes,
about,
okay, because that's where I wanted to go next, because deflation, but also Jamie Dimon had discussed stagflation. And I'm curious as to your thoughts on, is that an issue? Do you think that could be an issue? And if so, is it going to impact mortgages, and how?
yeah, I mean, so stagflation, the definition of that is a period of low growth and high inflation, essentially, right? So I think
And
that we
high
could,
unemployment. You got to throw the high unemployment is part of stagflation, which are not really seen yet. So,
well, I think we're going to see growth slow, and I think that we're going to see unemployment rise, but I mean, inflation's already come down significantly, and I think we're going to get next year to the low, somewhere around 2.4% or 2.3% on the core PCE numbers, which the Fed is really looking at. I mean, if you look at the Fed's own projections, is for 2024 core PCE to come to 2.4%. I think that we'll probably get there, especially as some of the shelter costs catch up and stuff. So I don't see a stagflation type environment where you have low growth, high unemployment, and high inflation, right? I think the inflation rate of change is going to come down towards the Fed's target. But I think that there's a better than 50% chance that we do get slower growth and higher unemployment, aka a recession, which, I don't think would be like a massive recession. It would probably be, in my opinion, short and mild, but will additionally help to get rates down.
Yeah, exactly. Okay, I just want to read a couple comments. So there is one from Jill who is she said, hey, she wants to make sure you know how important you are. She says, I'm taking away from my son, time away from my son who's visiting to be here with you. That's how
Thanks,
much
Jill.
she loves you. Cheryl says, thank you, Audrey, Kevin, and all who make this happen every week. You're much appreciated. As the information presented is very helpful. Merry Christmas. I wish you all the best in New Year. So I mean, that's really nice. Somebody was asking about the YouTube channel and not being able to see all of our shows that are available. I don't know why. I think they should all be on there for the
Well,
last
some
year and
we
a half.
don't post, like the CFPB ones we do not post.
Oh, right. We don't do
Let
that.
us.
We don't post the CFPB. That is correct. So there you go. The somebody said low sixes would be nice on the rates, and I'm just gonna say I was locking mid sixes
That's
for
awesome.
investment properties and cash out, which
Really?
with those LOPAs, those are great rates. So I mean, I was happy, the client was thrilled. That's one of the things that's good about the rates having been up as high as they were and staying up for a while, is that people got a little better perspective. Not everyone, but a little bit, where they are like, oh wait, okay, so it's not my God-given right to have 3% or 2% or whatever. So
Listen, the
yay.
most important question, Audrey, is do the numbers work? Because I had a client this week who had a 7.5% interest rate, but that rate didn't work because she was going to have to come in with $400,000 to complete the deal, versus I got her a loan at 10 and 7/8, but with all the money she needed to complete the deal, didn't have to come out of pocket $400,000, and it gave her another $100,000 to cover any interest expense for the transition. It was doing a bridge financing, and she's like, those numbers work great, thank you, Kevin. So the
It's
rate
the
didn't
cost
matter.
of doing business. We've talked about this
Yes.
a lot, because I've talked about my client who's like, Audrey, my cute little British client, Audrey, the most important question that I didn't ask was, what is the rate? And I'm like, no, Christopher, that's a dumb question. The most important question is, does it cash flow? And he went, oh, that's right. We have to remind them. Does it cash flow? You're doing a business transaction if you're doing an investment property. And so it really does boil down to, does it make sense? Same thing for single family. I'm going to live there. Can you make the payments? And then don't forget, to Dan's point, because I'm sure he could show us 15 charts that show us how, if you buy today, what the appreciation will look like and what you would miss out on if you did not buy today. So again, a lot of what we do is education, which can't be done by pushing a button, kids. And so what is our value in all this? They have been saying that we are going to be replaced by computers since before Dan was born, when I joined the mortgage industry 34 years ago. I don't know how old you are, Dan, but I'm guessing I'm close.
37.
Close, really close. Anyway, so it is, what is our value? We have to make sure that we are educating people. That's it. Okay, I have a quick question about Japan, Dan, very quick. So they have chosen not to raise their rates yet, right? They said they could, they might, they never have, or they haven't in a long time. How have they avoided raging inflation like the rest of us have had?
Well, Japan's interesting. Japan, they not only haven't like raised their rates, they have from the levels they were, but they're still negative, meaning it would be like if our Fed funds rate was negative.
Right.
Right. So they are in what's called NIRP, or negative interest rate policy. So one of the reasons why we saw the bond market react favorably this morning is they were anticipated, the Bank of Japan, Governor Ueda, who runs the show there, was anticipated to kind of lay the groundwork for coming out of that negative interest rate policy and raising their version of the Fed funds rate above zero. And they were expecting him to lay the groundwork to have that be sometime in January or maybe shortly thereafter. Instead of doing that, he quote said, we need to have some more patience and we need to wait a little bit longer and see how things react. So the market took that as a surprise, and you saw Japanese yields come down. And then because the globe's interconnected, global yields in Europe and here also fell. And Japan's also doing something called yield curve control, where, they essentially keep their 10-year equivalent of the 10-year treasury below a certain yield. It was, recently they allowed it to go above 0.5%. But before that, they had it below that. So, anytime it goes above it, they're buying. So they're doing a couple interesting things there. And it's really because they've had a hard time getting any inflation. Like,
Right.
I
They're
think,
in
Kevin,
a
you had
deflation
mentioned
spiral.
before, it's not good to have no inflation or deflation for any economy, right? So I think their inflation is like a little bit over 2%, but I think they want to make sure that it's going to remain above that and stay there, or potentially increase a little bit more before doing some of these things that would theoretically slow down their economy.
Now, you
So
talked about leveraging on, when you buy real estate, how, well, if the home values are going down, leveraging doesn't help. You're in trouble.
right.
And it's like,
Very
why buy
interesting.
the house today if tomorrow it's going to be $50,000 less? And
Yeah,
next
that
week
then you're in
it's $50,000 less.
2008 and 9 and 10, and then we all
Yeah.
want to jump off a bridge. So that's bad.
I do see a lot of negative stuff out there, though, in the media, once again, that I'm sure you
Really?
guys have to contend with. Like some of my favorite articles that I see out there. It's better to rent than buy in every market in the country, right? And then you look at the methodology, and they're looking strictly at monthly payment to monthly payment. I mean, why would you consider amortization, appreciation, tax benefits, rental increases, any of these things, right? But that's the media for you. So I, of course, am biased, but using tools to help you to really illustrate that, like the buy versus rent tool and MBS Highway, can really help you to really kind of crush that argument. But then I also see articles talking about 30% declines in home prices, right? So here's actually, I took a snapshot of the article, right? So it says some buyers could soon start to see big drops in prices.
Yes.
Growing inventory mixed with active price cuts is good news for people buying houses, and several experts are predicting big cost drops, including Jeremy Grantham, co-founder and chief investment strategist of GMO. Home prices are going to come down 30% would be a good guess, right? So I'd like to kind of look at some of these people's arguments and then try to really dive into them. So decline of 25 to 30% in prices. He talks about growing inventory, right? And listen, we've seen inventory grow a little bit like we do every single year at this
Right.
time, right?
Right.
You can see the seasonal inventory decline and seasonal inventory build. What's different about this year, and it's pretty clear to see, is we got much less of a seasonal inventory build than we typically get in every other market.
Right.
And the absolute number of inventory on existing homes is near record low levels, 1.1 million. I mean, that is extremely low. So, sorry, Jeremy, I don't agree with that being a reason, right? This growing inventory. He also talks about how 6.5% of homes had a reduction in their asking price. And that's true, but that also means 93.5 sold at their listing price or above. And actually 32% sold above the asking price. And this number is never zero, right? It's not like
Right.
in a normal market, this is zero and now it's 6.5. This number is probably somewhere between 3 and 4% or something like that. So yeah, it's a little bit higher than normal. But if you want to see what's really happening with home prices, this is it, right?
Yep.
So home prices in 2022, we saw them go up like 9% in the first half of the year. And then the second half of the year, they started to come down a little bit. And the media is talking about 25, 30% prices coming down, like I'm hearing now. So it's very reminiscent of that. But we saw home prices come down 3% in the second half of 2022 after the peak in June. But full year 2022 still saw 6% appreciation, which is still a good year. And then this is what's happened so far in 2023. Since
Right.
January, home prices started to rise again. And these yellow highlights show you, according to that report, when they broke the all-time high in home prices and began setting new all-time highs. So as of July, Case-Shiller reporting we've got new all-time highs above the peak from last year and continue to do that each and every month. FHFA since February, CoreLogic, Black Knight, Zillow since May, and we continue to set new all-time highs. And then if you look at 2023, the pace is somewhere between 6 to 7% full year appreciation, which is another fantastic year.
Incredible.
It might cool a little bit from here because remember, these reports are always looking backwards, right? So the latest ones we have are for October, but in some of these for September. So, the ones for September, you still have another 3 months of reports. In October, you still have another 2 months of reports. So you could see these numbers moderate slightly, but you have all these gains already baked in. Our forecast, Barry and I, if you look at 2022, we had expected 5.5% full year and we got 6%. So pretty close to hitting the target there. 2023, we forecasted at the beginning of the year 6.8% appreciation. We're on track for 7%, but I think it'll end up pretty close. And then 2024, this is our projection here, somewhere between 4.5% and 5%. But that could be a little bit on the low end, depending on what happens with rates and how lucky we get, because you could see a lot of that pent up demand on the sidelines coming back, and you could see home values increase even at a faster pace than that. But conservatively, we think somewhere between 4.5% and 5%.
Well, so let's talk about Grant Cardone for a minute because it seems like he has been skipping the sugar on his Wheaties in the morning and is a little cranky around real estate, which I cannot wrap my brain around. I sent you his article a few
Mhm.
days ago. I'm like, dude, what do you think about this? And you agreed it was a bunch of bupkis. Can you walk us through that a little bit?
Yes. So Grant Cardone, actually Barry just met him and spoke with him at one of the events he was at.
You
But
put him in timeout?
he you have to remember he's talking his book, right? So Grant
Exactly.
Cardone, I used to actually have in my presentations articles from him and Gary V, because they used to always both talk a bunch of smack about housing, right? And obviously they were wrong, right, with their articles.
Totally.
This was a few years ago. He was saying, and I have in my presentations, you have no business buying a home unless you have $20 million liquid in the bank. It's a terrible investment. Well,
Ridiculous.
you would have missed out on, ridiculous amount of appreciation and wealth creation over that period of time. Thank you very much. But, he always has said, don't buy a home, you're better off renting. And you have to remember his business model, he's got that Cardone capital. It doesn't help for him to tell people to go buy homes, right? He wants you to invest in his
His
company where
capital.
they're buying rental properties and generating income and not having an expense of a home. But it's been one of the best tools for wealth creation throughout time. So, if you look at um, the wealthiest people in the world, right? If you look at their net worth, 2/3 of all of the wealthiest people in the world's net worth on average comes from home equity. So,
Yeah.
Mhm.
and
Yeah.
somebody that owns a home versus rents has 40x on
Yes.
average the net worth of a renter.
Yeah.
Every
So I
time I see
disagree
one
with
of
them
those numbers,
wholeheartedly.
I pull it and I talk about it on here because it's just a great reminder that all of that is a bunch of noise and there's so much crap in the media. It's one of our favorite things to do is just slap it out of the air with facts. And
Right.
sometimes it isn't even the article that's wrong, it's the
It's the
headline.
title.
And so
Yeah, clickbait.
I had this
Yeah.
conversation with a reporter who listens, and I was yelling at her a while, it was a few months ago, about
Screaming, probably
what
even.
are you what?
Probably even screaming.
I don't scream, please. I just talk in a stern voice that makes my disappointment very apparent. Anyway, I was asking her, I'm like, what is going on with this? I said, there are these articles and the headline is ridiculous. And then you read it and actually it's basically factual. And she said, it's the editors. They take the article, they want to have some sensational thing that will get someone to click on it. It's just, so we just always have to remember that we have to do a little more digging, which is partly what we do here on Tuesdays, right? Is okay, here's what you saw, here's what your client saw, more importantly, in your realtors, here's what's real, here are the facts as we found them. We're not infallible, but there you go. Okay, back to my list, Dan. The reverse repo market. I keep hearing about this. It went from 2 trillion to 800 billion. Tell us what that means and how it matters to, if it does, to mortgages, so that anyone else who's listening to that and hearing it understands it.
Yeah, so that one can be a little bit of like a complex
Nope, you've got to
concept
dumb the crap down
to
of it,
grasp,
okay?
right?
Dumb
But
it down, Dan.
it's essentially like a facility that the Fed created that banks can like park their money, and it gets um invested in things like kind of like money markets and such, where they have liquidity there and they can get a return, and they can park their reserves there and such, where if it was in something like treasuries, they can be hurt by market moves or have that locked up for a period of time. The Fed also uses the reserve, that reverse repos and such sometimes to like pin their monetary policy, right? So like the Fed funds rate, if you ever seen the Fed do open market operations, right? It's like a lot of times they'll mess with that in order to keep the Fed funds rate in their target range. Like right now it's between 5.25 and 5.5. But you're right in that, the more important part of it is the liquidity of it being drained, right? So we've seen that reverse repo facility be drained. And, listen, I'm not going to pretend to be an expert on that reverse repo facility. But in some of my conversations that I've had with people like Lacey Hunt or Mr. Chang, who writes an amazing piece, they seem to think that that is going to cause a big slowdown in the economy once that gets to certain levels, right? It's been started to get depleted, but they think that when that gets depleted further back to some levels that it used to be at a few years ago, that can cause a big slowdown in the economy. I can get some more details on it, but I'm not an expert on the reserve
Okay.
repo facility.
All right. So it matters, but it's not direct. Okay.
Yeah, it's it's funny in talking with some of these individuals. I feel like everybody's trying to figure it out. Most of it, I'm
Right.
talking with some really brilliant people out there, but there's their TGA account, there's their reverse repos, there's just regular repos, there's a lot of moving parts there with the Fed and how they conduct their monetary policy, and it's tough to get your arms around some of it, but
It
it
really
has been
it's
depleting, and I it's my understanding that can cause a bit of a further slowdown in the economy.
I'm fascinated by all of this because we are so interconnected. I mean, why do I bring up Japan? What difference does that make? Well, it's because all of our markets are connected and on a worldwide basis. Why am I interested in that? Well, it's because it impacts us, whether it's direct or indirect, it's going to trickle down at some point. And so, how much or how little is the question, and do we need to concern ourselves with? All right, well, here's a little something for you. So this does impact things. So the contest of who is the least affordable state for home and auto is the results are in. And I'm sure that whatever state you're in, you're thinking it's got to be us. And if you're in California, you're definitely thinking it's got to be us.
Gotta be us,
But
I would think.
surprise, it is not.
What?
Yes, that is correct.
Louisiana?
Good job, Kevin. And he knows
Hey.
this because I've talked, we have a buddy in Louisiana, and so I get the lowdown on what's going on there. Louisiana has won the least affordable state for home and auto insurance. Congratulations. Nobody wants that distinction. I thought it was interesting though, because their residents are spending on average 2.93% of their income on insurance, and the US national average is 1.55%. So anyway, I thought that was fascinating. Also of note, FHA and VA volume increased 9.2% in Q3. That was while first lien mortgages overall declined by 3.2%. So don't stick your nose up at the air and think you shouldn't be doing FHA and VA loans, kids. You should. And also, just in other news, CFPB is working on rolling out a new proposed rule over loss mitigation. So they're really, really working on trying to keep people in their houses and offering options, the servicers, having the servicers offer options. We've talked about this quite a bit, but just remind your clients that you need to talk to your servicer. And if they're not responding, you need to complain to the CFPB, because they are paying attention. They do care, and they do want people to stay in their homes if they can. And then, if they can't stay in their homes, okay, they probably have equity, most of them. How many
Yep.
people don't have equity, Dan? Like, there's very few people who are underwater at this point,
In their
right?
homes. Oh boy.
I know you have a
it's-
slide or something on this. You must.
Yeah, the latest numbers from CoreLogic were, it was something like less than 2% of people with a mortgage. But if you were to then say how much is that of all people that own a home, it's, a fraction.
Yeah, and mostly it's probably people who just bought a house with 3% down or 5% down. Obviously, they don't have any equity because if they sold the house, they got to pay, 5% or 6% in real estate commission. So there's really nothing. But other than those people, I think pretty much most of the population has equity.
Well, I believe
Here's a number here. So the real-time number is negative equity. 1 million homes, or 1.8% of all mortgaged property. So,
Wow.
if you were to say, and I think you have like 63% of homes, or I forgot what percent it was of homes that are
Cash, fully owned.
yeah,
Loans.
it's a decent number of homes that are fully owned. So if you were to take that 1 million homes by all of it, you're sub 1% of homes at negative equity.
Nice.
Yeah, it is important for people to know there's help out there. It is not going to be the meltdown again, where you call your servicer and they're looking for ways to take your house away from you. That's not how it is. So, just a reminder that we have a full week of economic news that is coming out, and we cannot just like sit around going, duh, it's almost the holidays. It is the holidays. So tomorrow we have existing home sales. Thursday we have GDP. Friday we have PCE, which is the Fed's favorite measure of inflation. Dan, right? Dan,
Yes, it
they love
is.
to say that. Dan loves to say that. And new home sales, right? So what are your thoughts on PCE? You're thinking it's going to be okay? What are your
Yeah, no, I think we're going to see a little bit of improvement on both. I think we're going to see it come down by at least like 1/10 on both the headline and the core. And I think it's going to be well received by the market.
all right? And new home sales should be adequate. Like,
Yeah, new home sales has been a lot stronger than existing sales, right? But I think that if we take a look at what the estimates are real quick in real time, that's going to be coming out on Friday. So we have, let's see, new home sales. It's expected to increase, a little bit. It looks like they're expecting about 685,000 from 679,000. So they're expecting it to be up, between 1% and 2% or something like that. I think we'll probably see that happen. But I think the big one to look for is existing home sales, which we're actually going to be getting tomorrow. And existing home sales makes up, boy, it used to be 90% of the market, but now it's probably closer to like 75% or something like that, because there's been a
really?
lot more in the way of new home sales than existing home sales, because there's just no existing inventory. But they are expecting that number to actually come down very slightly, basically unchanged. But I wouldn't be surprised to see existing home sales surprise a little bit to the upside. This report is closings on existing homes in the month of November. So, probably people out there, shopping in September, October. It could be a tough report. I think the next one's going to be really good. but they're going to be getting better because we've seen rates come down significantly, over this last month. But remember, this is closing, so it could be people shopping out there in September and October, right? So that's when rates were, pretty high, around 8%.
Well, and just as a little aside, I've been calling my clients who are pre-approved but haven't found a place in the last 2 weeks. And it's interesting because, some were taking a little break and some were busy doing whatever. And so it's a good time to remind people, hey, prices are going to do nothing but increase, probably. And there's no time like the present, and get on it, for God's sake. So it's just, don't skate through the rest of the year is my messaging here. It is, we heard this stat, only 30% of people set a goal, and of those goals, 92% of them fail. So if you only have 30% of mortgage people who are actually thinking forward and trying to set a goal for 2024, and 92% of them are just going to drop the ball and not even, get over the finish line with them, it leaves it wide open for the rest of us. If you actually put some thought into what went right in 2023 and what didn't. I'm being so politically correct right now because the words that are zinging around in my head are not quite as polite. Anyway, if it wasn't great and if you would like it to be better, then you have to change and do something different. And you have this huge opportunity because most mortgage people are going to do the same thing next year that they did this year
Wait
and
for the
think
phone to
that
ring.
things will be better just because rates are coming down. And guess what, kids? Nope. You have to hustle. You've got to change what you're doing. You've got to go find some new business. You cannot just sit around waiting for it to happen. So
There are LOs that killed it this year.
there are. And so this is your Auntie Audrey saying, for God's sake, get it together and do something different in 2024, right?
Absolutely.
Right? Yes, exactly. And on that, we got a message from Jason, who does our YouTube channel. He says he's a week behind, but he will have this up as quickly as possible. And that if you click on, oh God, what did it say? Click on the channel, then you can find all the shows. That was it. And Dan, you've got a lot of comments in here saying that your dad would be proud. We're all proud of you. I have given Dan so much crap because I remember back in the day when he was this, shall I say, youngin' who, thought he knew a lot more than he did. And just, I tell him all the time, I'm like, God, I just want to, I'm so proud of you. You're amazing. You're one of our favorite for sure. And we are so grateful for you being here and joining us, and always, I love being able to just bounce things off of you. And, we can't say thank you enough to you.
Well, I really appreciate that. That means a lot to me. So thank you guys.
All right, kiddies. Well, that's it. Kevin, we are taking next week off.
I was going to say, who's our speaker next week? But there is none.
There is no speaker next week because we get 1 week off a year. And it is
drivers.
So we will miss you, but if you miss us, you can go on our YouTube channel and watch other episodes that are great. And I'm sure Jason will get this one up there as quickly as possible so everyone can enjoy this and share it with their friends. Dan, thank you, thank you, thank you. And thank
happy
you to
holidays,
everyone.
everybody.
Yeah, enjoy the holidays.
Thank goodness we're going into 2024. So have a wonderful holiday, and we'll see you in January. Bye,
Take
kids.
care, everybody.